Looks like you've got
Teaching demo for Accounting 101. First of all, I'd like to welcome you to the class. Accounting is a kind of a left brain activity. I don't know if any of you have thought about left and right brain activity, but your left brain is more logical. It deals with math and logic, and your right brain deals more with creative thoughts, such as words, imagination. So realize you may get a headache taking this class on the left side of your brain. Now, why is accounting important? Accounting is important for one reason. Everyone uses it. And so let's talk about that. Let's talk about who uses accounting. So I'm going to ask you guys, throw some stuff out. Who do you think uses accounting? Government. Yep, government uses it. Small businesses. Yep. What else? Good. Payroll. Yeah, that's an important one. Payroll. Taxes. Ooh, yeah, that's a part of accounting. Big businesses, multinational corporations. Yep. How about educational institutions? Yep, you better believe educational institutions. If you really think about it, who uses accounting is every single person in this room. We all use accounting every day of our lives. When you think about it, when you go buy a Subway sandwich, you're basically using accounting because they'll tell you it's $5.35 tax, and then you have a $6 bill and you have to make change. That's accounting. It's kind of math, but it's also accounting. So everybody uses accounting. And what I'm trying to do in this class is to make accounting simple and straightforward. I believe in the KISS principle. Keep everything simple, or keep it simple, silly. So we're going to talk about accounting. And one of the important things about accounting is there are basic logical equations that you use in accounting. And the first one is probably the most basic one of all, which is assets equals liabilities, don't mind my abbreviations, equals owner's equity. Owner's equity. This is the simplest accounting equation. Assets equals liabilities plus owner's equity. And think about it for a minute. What do you think an asset is? What do you think an asset is?
I wouldn't know.
You wouldn't know, okay. Anybody else? Oh, a house, very good. Your house is an asset. Your car is an asset. Your watch, that's a good one, is an asset. What else is an asset that you can think of? Farm, okay, I'll go with that. Farm, okay. These are assets. These are basically what you possess as an asset. Equals liabilities. What do you think a liability is? No, it's not when you have a son or a daughter. Sorry. A liability is basically what you owe on something. Let's say a house or a car or a watch or a farm. It's what you owe on that is an asset. Is a liability. So you can think of it this way. Assets minus your liabilities equals your owner's equity. Owner's equity is what you actually own in that asset. Let's do a good example. You have a house. It's $100,000, right? You owe $50,000 on that house. So what do you think your owner's equity in that house is? Anyone? $50,000, correct. $50,000. Now, if you're in certain areas of the country, you may have a $100,000 house and own $150,000. So what do you think your owner's equity in this house is? Well, it's a negative $50,000, and that's when you want to get out of it. So that's basically the simple accounting equation. A lot of people think accounting is really difficult. But if you learn the foundation, and think of this as a house here. And we are building a foundation. And we're going to talk about the accounting equation, about T accounts. We're going to talk about the financial statements, profit and loss statement. And don't let all this confuse you, but this is Accounting 101. This is the foundation for everything else. All payroll accounting, governmental accounting, taxation, even insurance is the foundation that you build everything upon for all your other accounting courses. Accounting 102, any other accounting courses you're going to take, this is your foundation course. So it's very important to learn this. So everybody repeat after me. The accounting equation is assets equals liabilities plus owner's equity. Or, if you want to figure out owner's equity, you change the mathematical formula to assets minus liabilities equals owner's equity. It's just that simple. Now, everybody kind of understand that? Any questions? Let's go on to the next area here, which is basically something called T accounts. And that's exactly what it looks like, a T. And T accounts always have a DR, a debit, on the left side, and a CR on the right side, which is always a credit. It doesn't matter where you stick it into the accounting equation, it's always going to be debit, left side, credit, right side. Repeat that. Debit, left side, credit, right side. Debit, left side, credit, right side. Okay? So now, here's the use of T accounts. T accounts are so beneficial in accounting because it keeps everything balanced. So let me just put up here a couple of the things, and we will start filling them in. Now, the most important aspect of T accounts is this. A debit, let me change out markers, sorry. One of the hazards of being an instructor with no good markers. Debits, wow. Debits always equal credits. Debits always have to equal credits. Say that. Everybody, debits always have to equal credits. Say it louder. Debits always have to equal credits. Very good. So, if I put a debit over here of 100, what do you think has to go on the credit side?
100.
100, very good, yes. Remember, debits always have to equal credits. I hope I can erase this. Ooh. No, I don't think this is a good marker. Where's the cloth here? It kind of erases, but it's not. So remember, debits always have to equal credits. So if, let's say on this side we have 100, I'm running out of ink here, and equals, let's say 50 on the credit side, doesn't work. You have to have it always equal. Debits always have to equal credits. Okay? So now, the benefit of this is you can use the T accounts to balance things. So let's say you have an asset that's $1,000. Okay? That's a debit. Plus, minus. Now, if you have a $1,000 asset here, that has to equal a credit either over on the asset side, the liability side, or the owner's equity side. So, let's say you buy a new car for $1,000. I don't know where you're going to find one that cheap. So, you basically have $1,000 liability. So, debits equal credits? Absolutely. If we plug it into the formula up here, we have a $1,000 car, $1,000 car, $1,000 car, And we have a $1,000 liability, so what do you think your owner's equity is? Zippo! You don't own anything. Like most college students don't own anything. So, but the nice thing about this is it balances it out, the accounting equation. So let's take a look at this a little bit more in detail, the accounting equation. You have debit plus credit minus. On this side, this is a minus, this is a plus. Notice how it mirrors, how it reverses itself. All of a sudden, you go from debit on this side as a plus and a credit is a minus, but on this side, it's a plus and a minus. And owner's equity is a minus and a plus. And the reason for that is that this is a mirror of assets for the T accounts, debits and credits. They still have to equal. Don't get confused with the plus and minuses, because we're going to deal with that in the second class. For now, just understand that that's how the T accounts work. So let's take another example. Yell out something. An asset. Something you don't sit on. Come on. Yell something out.
I don't know. Motorcycle.
Motorcycle. Okay, motorcycle. So you pay $5,000 for a motorcycle. You now have an asset in your possession of $5,000 once you sign the papers and they make you sign guarantees and all that stuff. And let's say you put $1,000 down on that motorcycle. So you would now have $1,000 in owner's equity. Correct? Debits don't equal credits. Here we have an asset of $5,000. We have a credit of $1,000. So we need to balance that. Well, what do you think happened? Well, you took out a loan for $4,000. Okay, so there, you now have $5,000 as a debit, $4,000 as a credit, $1,000 as a credit. These two together equal $5,000, right, on the credit side, and $5,000 on the debit side. Therefore, assets equals liabilities plus owner's equity. Or, as you can know, we can write it this way. Let's say you didn't know the liabilities. You could take assets minus owner's equity equals liabilities. Because you didn't know how much your loan was for, right? Until they told you it's going to be 10%. Yeah, forget that. So $5,000 as asset, $1,000 in owner's equity, and guess what you get? $4,000 in liability, which takes you about 20 years to pay off, right? So that's basically the accounting equation. Now, realize this is very basic and simple, and we're going to expand out and get more involved in it as we go along. One of the interesting things about the accounting equation, sorry for the mess here, should have brought a scrubby dummy. So, is that owner's equity is made up of basically a second equation. And this equation is called the income or profit and loss equation. And what this equation is it's part of owner's equity. And what that is that you have income or revenue, correct? You get income or revenue, such as a paycheck, correct? And you, of course, spend that paycheck, which becomes expenses, and that equals profit or a loss. If you spend more than you make, you have a loss. If you make more than you spend, you have a profit. So that's kind of how it works. So now, if you're looking at the income statement, or I'm sorry, the income or profit and loss equation, it's real simple. Revenue minus expenses equals profit or loss. You've all done this before. You have income, let's say of $400 you get, and you go and you spend $500 of it, then you have to put it on a credit card, liability, $100, so you basically have a loss. So The whole key is to remember revenue minus expenses equals profit or loss, which is basically part of your owner's equity. And how that works is simply this. If you have a profit, you have a gain in owner's equity. Because if you have a profit, you have more owner's equity, don't you? You have more money. Because over on this side, you're going to have more money. Because remember, this equation has to be affected. So let's say you have, simple, $100 profit. The equation doesn't work, does it? Where's your credit that equals the debit? Aha! You got to have it, what? Over here on the liability, decrease your liability, pay off your credit cards, or you put the cash in the bank, or you have it on hand, $100. $100 equals $100. So therefore, debit equals a credit, and therefore assets equals liability to owner's equity. It's that simple. We're not getting into any complex areas. And like I said, Accounting 101 is very basic. So now let's talk about how this all relates to the financial real world. Everybody, every single business, organization, company, even people, real estate companies, you name it, banking, everybody does financial statements, either in your head or on paper. And in accounting, this nice little accounting equation is called a balance sheet. Sorry, my marker's dead. Oh, good idea, shake it. Okay. Balance sheet. Still doesn't work. Okay. So basically, a balance sheet is assets equals liabilities plus owner's equity. That's a balance sheet. Basically, you know, I have $100,000 in assets. I have $50,000 in student loans. Therefore, I have owner's equity of $50,000 until I pay off my student loans when I have nothing. Is that correct? Yeah, pretty much so. So then, the profit and loss or income statement is basically exactly this, profit and loss equation. It's basically called an income statement in the old days. They used to call it income statement back in the 50s, 60s, and 70s. Then in the 80s and 90s, they started to go to a profit and loss statement, then changing it over. So now it's a profit and loss statement, and that's basically the equation of revenues minus expenses. Now, what I'd like you to do is think about this. Go home as a self-assessment tool. Think about all your assets you own and add them up. And this is just for you. I don't want you sharing it with anybody except for family members or someone you trust. All your assets you own, all the liabilities you have, and what your owner's equity is. And then you can see how this equation works. Well, thank you, and we'll talk to you later.